Greetings to everyone. This is Ms. Kurt welcoming you once again for today's webinar. Exactly 5 days are left before the implementation of corporate tax. As an FTA approved tax agency and in our effort to give light to different aspects of corporate tax, we plan to provide a series of webinars to discuss about the explanatory guideline previously released by the respective authority. Through this, AMCE aims to equip you with the necessary knowledge to navigate corporate tax law successfully. As it is important to assess the applicability of corporate tax to a person for today, we will be discussing about taxable person and applicable tax rates. Together with me is Ms. Mariam and Mr. Muhammad Sharik, who will be joining us in addressing your queries on the question and answer session. So as usual, the first half of the session would be for the discussion of the relevant topic for today. You may send the questions or queries that you have on the message box below, and we will have it addressed to the best of our knowledge on the second half of the session. Okay, so the webinar pointers for today will be starting for defining key terms that we would be mentioning all throughout this webinar, which is the definition of a taxable person, state source income, and permanent establishment. This would be followed by the categories and determination of taxable person, together with the investment manager exemption, partners in an incorporated partnership, and family foundation. We will also be discussing about corporate tax base as well as the corporate tax rate to be applied for a taxable person. So the definition of a person includes both of a natural person and a juridical person. Natural person can seem to be defined as an individual, and for certain types of business activities, natural persons can form a sole establishment or a civil company. So for corporate tax purposes, these entities will be disregarded and treated as the natural person or persons owning them because of their direct relationship and control over the business and their unlimited liability for the debts and other obligation of the business. On the other hand, juridical person are entities established or otherwise recognized under the laws and regulations of the UAE or under the laws of a foreign jurisdiction that has a legal personality separate from its founders, owners, and directors, has its own rights, obligations, and liability, and that the entity would normally continue to exist irrespective of changes in the persons or persons owning it. So some of the examples for juridical persons are LLC, foundation, and public or private joint stock company. Now we would be moving on with defining state source income. So determining whether an entity is deriving state source income is primarily relevant to non-resident person. So for this one, we would be discussing it on the upcoming slides that we had. So an income can be considered as a state source income if the income is earned from a resident person who is we can consider automatically within the scope of corporate tax, or if it is derived from activities or assets located in the UAE. So additionally, where it is derived from a non-resident person and the income received has been paid or accrued in connection with and attributable to a permanent establishment of the non-resident person in the state, this income can be considered as state source income as well. Lastly, any income irrespective of the location and residence of the person from whom the income is received, such income may be considered to have a UAE source for corporate tax purposes where the place of use or performance of the income generating activity are located in the UAE. So some of the example of state source income are income from sales of goods, wherein they are considering where the sales and resulting transfer of title takes place. Incomes from services, where it is considered where the service is rendered in the UAE or where the ultimate recipient or beneficiary of the service is located in the UAE. Sorry, please let us know if there's any problem with the audio or sound. Okay, so I think the voice is clear. If in any case you're facing any problems with regards to sounds, please let us know in the chat box so we will have it checked immediately. Also, I think there are also some attendees who have problems in accessing the presentation. So in this case, we do advise you to just rejoin once again so that you could access or have an presentation for this. So continuing, another example of state source income or income from a contract where it is considered where the place where the contract is performed, or from movable or immovable property where the property is located. Another example of state source income are disposable of share and capital rights, income from intellectual or intangible property, as well as interest income and insurance income. Another important term or another key factor to consider for the implication of corporate tax for non-resident person will be the permanent establishment. So the definition of permanent establishment in the corporate tax laws follow the principles provided in Article 5 of the OECD Model Tax Convention on Income and Capital. A permanent establishment could either be a fixed or permanent place or a natural person, as what you can see from point 1 and 2. So the following are the three instances that could create a permanent establishment for a natural person. So on point 1, it is important to consider the place where business is wholly or partly conducted. So for this one, there must be a fixed or permanent place, which implies the existence of physical location in the UAE with some degree of permanency, like for example, branch, office, workshop, factory, lands, or buildings. So on some other cases, it is possible that no permanent establishment would arise if the activities is carried out through a fixed or permanent establishment in the UAE if that specific establishment are only or solely for preparatory or auxiliary nature. Like for example, if a place is only used to store, display, or deliver the non-resident person's good, or if that specific place is only for keeping or stocking of goods in the UAE for the purpose of processing by another person, such circumstances would not give rise to a permanent establishment. So it is also important to know that there must be a business that is being conducted through the permanent place or establishment. So for the second point, a person has or habitually exercises an authority on behalf of the non-resident person. So this includes or cover the situation where an employee or other person act on behalf of the non-resident person and conclude contracts and otherwise enter into legal obligation on behalf of the non-resident person. So the focus on the person's role in the negotiation of contracts and not on the formal act of signing or concluding a contract. The person should be authorized to take part and negotiate in all elements and details of a contract. So there are also some exemption for a natural person or where a natural person could not give rise to a permanent establishment for a non-resident person if, for example, that specific person acts as as an independent agent. So on those kind of cases, they would not be considered as a permanent establishment for the non-resident person. For the last point, permanent establishment could also be considered like through any other economic or business link to the UAE that is considered sufficient to bring such a person within the scope of corporate tax. Just an additional information regarding the ministerial decision number 83 of 2023 for the determination of condition under which a natural person can create a permanent establishment for the non-resident person. So it is mentioned there that an exceptional circumstance is a situation or an event beyond the natural person's control, which occurred while he was already in the state, which he cannot reasonably predict or prevent, and which prevented him from leaving the state as originally planned, including but not limited to that of a public nature or a private nature. So one thing to also consider for this one is if the natural person did not express any intention to remain in the state when the exceptional circumstances end, then such presence would not give rise to a permanent establishment for non-resident person. With regards to public nature, this could refer to like for example public health measures, travel restrictions that is being imposed, legal sanctions imposed on natural persons, acts of war or occurrence of terrorist attack. Private nature could refer to emergency health condition of natural person or relatives up to their fourth degree of kinship or any other situations that would directly or specifically be directed for the natural person. Please let us know if the voice is breaking off or if there's any problem with it. Right. So continuing, we would now be proceeding with defining the taxable person, or in which basis could you consider a person as a taxable person for corporate tax purposes. So, for corporate tax purposes, there are two categories on taxable person, which is the resident person and the non-resident person. If in any case a person doesn't meet the certain conditions that we will be discussing in the determination whether it would be a resident or non-resident for corporate tax purposes, you can consider or it would be falling outside the scope of corporate tax. So for the resident person, it could either be a juridical person or a natural person. For juridical person, it would be including those entities incorporated within the UAE, as well as those entities incorporated outside UAE, but is effectively managed and controlled within UAE. So for entities incorporated within UAE, these entities will automatically considered to be a resident for corporate tax purposes. It's regardless if the company is in mainland or free zone and irrespective of their type and level of activity performed. So for those companies incorporated on foreign jurisdiction but is effectively managed and controlled within the state, it is very important to consider where the mind and management of the entity or the activity it undertakes to generate income reside. So, as solely considering the place of incorporation will allow manipulation to where the profit is being taxed. The key factor to consider is where the key management and commercial decisions concerned with the strategic and policy matters necessary for the conduct of the company is being given. So, simply stating it could be where the board of directors are making the necessary or strategic decisions. Some of the factors that you could also consider are the location of shareholders or the location of a person to which the board have delegated its decision-making function. So, considering the above, it is not necessary for its board members to be a resident in the UAE, so that you could consider a company is being effectively managed and controlled within the UAE. So, for natural person, these are persons who conduct a business or business activity within the state. So later on the upcoming slides as well, I will be discussing about the factors that you would have to consider to know whether a natural person will be subject on corporate tax. So on the non-resident person side, it could be a non-resident person that carries out activities through the permanent establishment in UAE, or a non-resident person that receives state source income will be subject to corporate taxes. So as I have mentioned a while back, this refers to income arising from some certain activities and transactions that have a connection with the UAE but are not carried in through permanent establishment. So lastly, for non-resident person who has a nexus in the state or having a connection or link in the UAE will also be considered as a taxable person. So one thing to take note as well when regards to UAE branch of a resident person. So a UAE branch of a resident person will be treated as the same taxable person, recognizing that branches are an extension of their head office as opposed to being a separate juridical person. So this means that a resident person should include the income and expenditure of all its domestic branches in its tax return. So for Cabinet Decision number 49 of 2023, these are the categories of business or business activities conducted by a resident or non-resident natural person. So natural person business or business activity will be subject to corporate tax if the total turnover exceeds 1 million AED within a Gregorian calendar year. So the following sources that was mentioned on the presentation shall not be considered in the turnover that was mentioned, such as the wage, personal investment income, and real estate investment income. From this, we can conclude that activities neither conducted through a license or requiring a license from a licensing authority in the state, nor considered as a commercial business, shall not be considered as being contributed to the turnover of the natural person. So the income that will be derived from these three activities will not be considered regardless of the amount of turnover that is being derived. Mostly, these are activities that are earned from the personal capacity of the person. So moving on with investment manager exemption. So for this specific article, in the corporate tax is meant to prevent a foreign person from being considered as having a permanent establishment in the UAE or income acquiring a source in the UAE as a result of engaging a person in the UAE that provides investment management or brokerage services. So this allows the regulated UAE-based investment managers and brokers to provide discretionary investment management services and to enter into transactions on behalf of foreign customers without triggering a permanent establishment for the foreign investor or a foreign investment entity. This is achieved by providing that a UAE-based investment manager shall be treated as an independent agent. So to be treated as an independent agent, there are 6 points that they have mentioned. So for the first one, the investment manager must be appropriately licensed to perform the activity and is subject to the regulatory oversight of the licensing authority within the state. The second one is that transactions must be carried out in the ordinary course of investment manager's business. So, for example, a UAE-based and regulated management firm that provides portfolio management services to a foreign person or persons as part of their ordinary investment management function. So, for the point three, investment manager must act in an independent capacity. Most of the time, an investment management acts exclusively or almost exclusively from the foreign person. Hence, they may not be legally or economically independent from that foreign person. However, they must demonstrate their independent capacity in relation to the act carried on for the foreign person. So, for the fourth point, which is the remuneration, must be at arm's length. So both the foreign person and the investment manager must act on arm's length terms to be considered as if they are both independent parties. Also, investment manager must not be an agent in the UAE in relation to other income or transactions and some other conditions as well as prescribed by the minister. Moving on with partners in an unincorporated partnership. Unincorporated partnership are defined as a relationship established between two or more persons by contracts, such as a partnership, trust, or any other similar association of persons in accordance with applicable legislation in the UAE. So, a contractual relationship in an unincorporated partnership is broad and could be a verbal arrangement and even the conduct between parties. Hence, it doesn't require the relationship between the relevant person to adopt the form of a limited or general partnership that is formalized in a written partnership agreement. An important factor in determining whether an arrangement or entity is an unincorporated partnership is whether one or more of the partners that participate in the management of the relevant business have direct and unlimited liability for the debts and other obligations of the unincorporated partnership and its business. So for the purpose of corporate tax, an unincorporated partnership is considered as fiscally transparent. So this shall not it should not be considered as a taxable person in its own right or subject to certain conditions. On the other hand, persons conducting a business as an unincorporated partnership shall be treated as an individual taxable person for the purpose of the corporate tax law. So this could mean that the assets, liabilities, income, and expenditure of an unincorporated partnership shall be allocated to each of its partners relative to their distributive share in that unincorporated partnership. So generally, the distributive share of each partner is determined in the contract that formed that partnership. On this specific article on corporate tax, they have mentioned that the partners in an unincorporated partnership can make an application to the authority for the unincorporated partnership to be treated as a taxable person. So if the application is made and approved, the conditions for a partner in an unincorporated partnership, as I have discussed a while back, will not be applied. And each partner in the unincorporated partnership shall remain jointly and severally liable for the corporate tax payable by the partnership for those periods when they are partners in the unincorporated partnership. Now we're coming with the family foundation. So, whilst generally a person's employment income and income earned from their personal capacity will not be subject from corporate tax. However, the trusts and foundations that have separate legal personality would in principle be treated as any other juridical person and would therefore their income be subject to corporate tax. Different structure could be used by a natural person to manage their personal wealth and investment. As in some cases, trust or foundation is merely used to hold and manage assets and wealth on behalf and for the benefit of beneficiaries, which allows a family foundation to apply to the authority to be treated as an unincorporated partnership and hence not be subject to corporate taxes. So a family foundation that seeks to be treated as fiscally transparent is not permitted to undertake activities that would have constituted a taxable business or business activity. Moreover, application must be made upon considering certain conditions. So we have specified here three conditions that the family foundation must meet to be able to apply to be treated as not being subject in corporate tax. So it must be established for the benefit of identified or identifiable natural persons or for the benefit of a public entity or both. So the public benefit that was mentioned is not necessarily required to be listed in a cabinet decision as a qualifying public entity. So it simply means that this public benefit entity is a non-profit organization. So the second one is the principal activity of the family foundation is to receive, hold, invest, disperse, or otherwise manage assets or funds associated with savings and investment. So, as I have discussed, the family foundation must not undertake any activity that would constitute as a business or a business activity. They will be solely be for the purpose of management of cash, publicly traded securities, private stock, real estate, and other assets held or investment made by the family foundation. Lastly, they must not have a main or principal purpose of the avoidance of corporate tax. So this is in relation to the general anti-abuse rule that was also mentioned on the corporate tax. Now we're going to move on with corporate tax base. So for corporate tax base, we will be discussing the determining the basis to which the resident person or non-resident persons are subject to corporate tax. So which could apply for both source and residence basis. So for the residence basis that I have mentioned, this could be resident person is subject to income derived from both UAE and non-UAE sources. While for source basis, this mostly applies for non-resident person that is taxed on income derived from sources within UAE. So for the resident person, the juridical person's income derived from outside and within the state are both subject to corporate taxes. So while both UAE and non-UAE source income derived by a resident person is within the scope of corporate tax, to eliminate or reduce potential international double taxation, the corporate tax law exempts certain income earned from overseas. So this exempt income could be those income earned by a foreign establishment that is subject to tax in a different jurisdiction already. And a foreign source income that cannot be exempted are resident person may claim a credit for the tax paid in foreign jurisdiction as well. So for the natural person, the income related to the business conducted within UAE will be subject to corporate tax insofar that the income or the business has been conducted within the state. So if a natural person carries on a wholly separate business in a foreign jurisdiction, which is not related or connected to the business conducted in the UAE, the income from such other business will not be taxable in the UAE. Similarly, any income earned from activities and assets that are not related or connected to the business activity conducted in the UAE will not be within the scope of corporate tax. So, non-resident persons' income attributable to permanent established in the UAE, state source income, and income derived from a nexus will be subject to corporate tax as well. So, for the last part, we will be discussing about corporate tax rate. So for corporate tax rate, the taxable income below 375 AED will be taxed at 0%. Exceeding that amount or exceeding 375,000 AED would be taxed at 9%. So let's say if a company has a taxable income amounting to 400,000 AED, the exceeding amount, which is 25,000 AED, will be taxed at 9%, meaning to say they would have to pay 2,250 as a liability in purpose for the corporate tax. On the other hand, for the qualifying free zone person has a different basis to identify the tax rate to be applied on their income. So for qualifying free zone person, their qualifying income would be subject on 0% corporate tax rate, while income that does not meet qualifying income condition will be taxed at a regular 9% corporate tax rate. So till date we are yet or we're still waiting for the minister's decision to be released to be able to clarify regarding the qualifying income that would be considered for qualifying free zone person, which will be taxed at 0% tax rate. So that's it for the discussion of today's relevant topic. So you may now send your questions or any clarification that we will be having during the discussion on the message box, and we will have it addressed on the question and answer portion.